Hello and welcome to another video from UNM.NU. That's the University of New Money. Today I wanted to talk about a topic which excites everybody, paying taxes. Now, it's an important topic in the cryptocurrency industry because cryptocurrency is very new, so even with the tax professionals that I work with, they may not be familiar with the way to handle cryptocurrency and taxes. The easiest way I would describe it to them is to treat it like stocks in terms of long-term and short-term capital gains and losses. Cryptocurrency right now I would say is most similar to buying and selling stocks. But in this video all I want to focus on is first in, first out, specific ID, essentially ways that you can maximize or minimize your gains or losses on cryptocurrency because you can use that to your advantage. So I have an example which I'll go through later. This article is pretty good. It talks about that the IRS is going to let you specifically identify a unit of cryptocurrency when you make transactions. So it'll be easier when I go over the example, but with first in, first out, which is FIFO, that means the first thing you buy is the first thing you sell. So if you buy a Bitcoin, the first Bitcoin you ever bought, if you then sold a Bitcoin, that's the one that you would use to pair to see your capital gain or loss. With LIFO, it's the opposite. So the last Bitcoin that you bought, if you then sold a Bitcoin, that's the one you use as your cost basis to see your gain or loss. And then for HIFO, which is highest in, first out, you just get the highest amount you ever paid for a Bitcoin. And if you go ahead and sell a Bitcoin, you use that as your cost basis, which would go ahead and minimize your gains in the case of Bitcoin actually increasing in price from the time you bought it to the time you sold it. You could also do another form of LIFO, which would be lowest in, first out. That would just be the opposite of highest in, first out. The key is that you can really do specific identification. You can choose which Bitcoin you bought and sold when you did it to pair it up. So let me go ahead and go to the example because I think it's easier to show this as an example. See, here I went ahead and made everything a long-term capital gain. That's where you've held on to the Bitcoin for at least a year. I can make another video later talking about the difference between short-term and long-term capital gains. For the most part, long-term capital gains are better because if you experience a long-term capital gain, you'll be taxed at a lower percent. As of now, it's 15%, as opposed to your income tax rate, which could be as high as about 40%. So you usually want to have a long-term capital gain as opposed to a short-term, but there are exceptions to the situation, which I'm not going to get into here. Here I'm going to focus on the fact that you bought 4 Bitcoin during 2019 and you sold it in 2020 for a long-term capital gain. If you go ahead and use the FIFO method or the lowest method in order to maximize your gain, you would pair the $20,000 you sold the Bitcoin for October 1st, 2020. And by the way, these are imaginary prices. I know the price of Bitcoin January 2019 was not $5,000. It was kind of close. And then in July of 2019, it wasn't $10,000, although that might be close to. I didn't actually look at the price of Bitcoin on these dates. I'm pretty sure they're wrong. I know they're wrong. But we're just using this as an example. So if you want to look at your gain on October 1st, 2020, when you sold your Bitcoin for $20,000, if you pair it with the Bitcoin you bought on January 1st, 2019 for $5,000, which could either be first in, first out, lowest in, first out, I prefer to just think of these tax situations as specific identification. If you really want to maximize your tax implications with cryptocurrency, I recommend specific identification, choosing specific blocks of Bitcoin to maximize or minimize your gains or losses depending on your situation. In this case, you had a gain of $15,000 with the FIFO method. If you use the LIFO method, you only have a $10,000 gain because the last in, first out is the Bitcoin purchased on July 1st, 2019. The highest in, first out is the April 1st, 2019 for $15,000. There you have your smallest capital gain of $5,000. And specific ID, if for whatever reason you wanted to pair the $12,000 Bitcoin you bought on May 1st, 2019 with the Bitcoin you sold October 1st, 2020, you would have an $8,000 capital gain. So as you can see, based on how you pair the Bitcoin you sold on October 1st, which is just one date, and then you bought Bitcoin on 4 different dates, based on how you pair your selling date with your 4 different buying dates, you could have 4 different capital gains. And based on your situation, you may want a huge gain. Let's say you made a low amount of income in a given year, which with everything that's going on this year in 2020, maybe you made a low amount of income. Then you actually want to have a high capital gain for 2020, that way you would have lower capital gains in the future. So you may actually want to maximize your capital gain in a given year, or you may want to minimize your capital gain. That way you pay the lowest amount of taxes for a given year. Just depends on your situation. Very quickly, if you're experiencing a capital loss, don't forget that you can always take up to a $3,000 deduction of your income for a given year, at least the way the tax rules are written right now. Now, I'm not a tax specialist, I'm not an investment advisor. I am a certified public accountant, so I feel okay talking about these issues, and I have a background in economics, accounting, finance, all that good stuff. But definitely consult a tax professional if you have questions about these issues. But I just wanted to give you guys some options just to keep in mind. Again, I will not be held liable for any cryptocurrency transactions you make and the tax implications thereof. But these are just recommendations I would give. These are things I'm keeping in the back of my mind when I decide to sell some of my cryptocurrency when and if that day comes. I actually prefer to use my Bitcoin like a currency in the future. Right now, all I've been doing is buying and holding my Bitcoin and cryptocurrencies, but I know there'll be a point where I could possibly sell it and not do a direct transaction. And even if you do a direct transaction, there are tax implications. I'm not going to get into that here, but it's important to know the tax implications that can affect your income, the taxes that you have to pay, and your ultimate gain from investing in this market. So if you've enjoyed this analysis and this video, please give this video a thumbs up. And if you haven't subscribed to the channel, please subscribe and hit the notification bell to get notified of future videos which come out from this channel. Again, this is not professional tax advice, but I just wanted to go through different tax situations just to get in the back of your mind. Just be aware of this as we go into the future in this wonderful world of cryptocurrency. Hope you have a wonderful day, and I'll talk to you later. Goodbye.